Dear students, myself Bijendra Kumar Singh, economics faculty in Vajiraman and Ravi. There are some other economics faculties also. I'm here to take some portions of economics, like I teach fiscal policy, inclusive growth, sustainable development, employment and unemployment. So I'm clarifying some of the doubts and some of the concepts related to fiscal policy and budget. So like when we say monetary policy, we always talk about money and banking. And money banking governed by a supreme authority called as the RBI, always announced by RBI after every 2 months by the Monetary Policy Committee. RBI chairman is the head of it. But look at that, when we say fiscal policy, look at the Hindi name of it. Fiscal, the Hindi name it Raj Koshiye. Raj, English word meaning is rule. Koshiye means money. It is talking about money of the ruler. And who is the ruler? At present government, in the past kings. So this policy talks about money of the ruler and obviously the government. GDP, when we say that, primary sector, agriculture, secondary manufacturing, tertiary services, like suppose I'm telling you, primary 100 crore, secondary 100 crore, tertiary 100 crore, total 300 crore. Then this is the money of the people, not the government. When we say that, in this entire process, whatever the tax generated, when I am the part of tertiary sector, when I earn money, I pay the tax. The tax is the income of the government. It means this one. When I take license, I pay the money to the government. License is the income of the government. So government income is in the forms of tax revenue, non-tax revenue, some recovery of loans, and even selling properties to the private. These all are. Government presents its fiscal policy with the help of budget. Budget presented at 11 a.m. Past actually practice is at 5 p.m. That was the British practice, but we changed in the year 2000. There's no particular rule behind it and there's no particular convention. By practice, government is doing that, presenting the budget at 11 a.m. It can be changed also. Budget, it is a record of receipts and expenditures. Receipt, government gets that, expenditure government does. Whenever there's a mismatch, deficit, like fiscal deficit and all. Receipts in terms of revenue and capital. Revenue receipt in terms of tax revenue and tax revenue, non-tax revenue. Capital receipts, recovery of loans, borrowing, disinvestment. Expenditure, revenue expenditure and capital. Revenue expenditure itself in developmental revenue expenditure and non-developmental. Capital expenditure in terms of repayments of loans and construction of roads, etc. What I'm doing, I'm defining this revenue receipt, capital receipt, revenue expenditure, capital expenditure in such a way that you can easily identify that why borrowing kept under the capital receipt, why personal income tax kept under revenue receipt, why creation of construction of roads came under capital expenditure, but why subsidy comes under the revenue expenditure. That I will define. Look at the revenue receipts. When we say revenue receipts, the definition is that they are not obtained through selling of government properties. They are not obtained through selling of government properties, and they do not create any kind of liability for the government, burden for the government. Look at that. Taxes, they are the surplus with the government, income of the government, you can say in one sense. So how they will create liability, burden for the government? Government is not getting them through selling of something. If my income would come under the certain, you can say that category, I will have to pay the tax. So the government is not selling anything. It is the receipt of the government, so it is not liability according to the definition. Apart from that, it is not obtained through selling of anything. Similarly, when we say that non-tax revenue, when you study in the government school, nominal fees we pay, revenue of the government non-tax, government hospital nominal fee we pay, non-tax. Fines, when we move without seat belt and helmet, we pay the fine. License, driving license, we pay the government. Apart from that, we see 4G spectrum auctioning, 5G, government gets the license fees. Whenever SBI Bank belongs to the government, earns the profit, part of profit given to the government, dividend. ONGC makes the profit, part of profit given to the government, dividend. And when government gives its property on rent or temporary ownership called as lease, that is asset monetization. Not selling, only giving on rent. Recently, in the newspaper given, NHAI completed National Highway Authority of India, completed asset monetization of 1 lakh crore. Means, if this is the national highway road, beside roads, government land, government given on rent to restaurants, to petrol pumps, to hotels, and through that government earns the money and generate employment also. These are the assets. So do not create liability burden not obtained through selling of government properties. But the reversal of that is the definition of capital asset. They may create liabilities like borrowing is the burden on the government. They may be obtained through selling of government properties like disinvestment. So government property, Tata, government sold its Air India to Tata. And they may have the long-term character. But the government of India has given 5 years loan to Sri Lanka. Loan would be recovered after 5 years, long-term character. So do not create liability and not obtained through selling of government properties, but may create liability burden and may be obtained through selling of government properties. So easily you can identify. If government of India has taken a loan from World Bank, liability, capital asset. But if government of India has increased the personal income tax, not a burden on the government, revenue asset. If government of India has sold Air India, may be obtained through selling of government properties, disinvestment, this. And if the GST rate government has changed, that is what? Revenue asset. Isn't it? This. But similarly, when we say revenue expenditure, they do not create asset and they do not reduce liability. Like it is for maintenance. Like there is a government school. To maintain that, there is a need to pay the salary to the teacher. And that is to maintain that character of that school. If there is a government hospital construction, so to maintain hospital, salary paid to the staffs, revenue expenditure. To maintain school, salary paid to the school teachers and the non-teaching staffs, either this one, revenue expenditure. You say that. But developmental revenue expenditure, we say that, developmental revenue expenditure for the developmental work. Take one school, government school. That when school is there, non-teaching staffs, they maintain the entire discipline and everything. But unless and until the teacher would come, development cannot be done. Every minute knowledge enhancement would be done when the teacher would come. So salary paid to the teacher is a developmental revenue expenditure. The salary paid to the non-staff, although essential, but that is non-developmental. Similarly, salary paid to the doctor, since every second adding life, saving life, developmental revenue expenditure, salary paid to the non-medical staff, they are arranging the things, that is also essential, non-developmental. Similarly, the reversal of that as a definition of capital expenditure. Like, they may reduce liabilities like repayment of loans if government has taken loan and paying it, reduction of liability. And they may create asset like construction of roads. This is road. Now more road construction, more asset. Airport, suppose 70, now more than 70, then asset creation. Railway line, suppose 10,000 kilometers, suppose 11,000 kilometers now increased. So asset creation. So this one. And that's why government always say that capex, capital expenditure, would reduce the revenue expenditure. For example, take one village and one city. And see, roads are bad. So the village people cannot carry their products, their potatoes to the city where it is sold at 20 rupees per kg. They are forced to sell it to the intermediaries at 2 rupees per kg. But roads would be constructed. They can carry this to the city. Cost is 2 rupees, their cost of production, 2 rupees transportation cost, 2 rupees tax and here and there, 6 rupees total cost. They will sell it to the wholesaler as 6 rupees cost, 14 rupees they are earning. They have more earning, better development of them. And if government will announce even procurement price at 6 rupees per kg, they will not sell them. So development of roads, which is capital expenditure, would reduce the reliability of the people on the revenue expenditure, which is the subsidy, the subsidized purchasing. That's why capital expenditure always creates development in the society. So this budget, and we talk about this entire, so always consider that GDP, primary sector, secondary and tertiary, that is the income of the people, not the government. But in the generation of income in the primary, secondary, tertiary by the people, they pay the taxes, they pay the license. These are the income of the government in the form of tax, in the form of non-tax and all. Thank you to all for this session.